Internal rate of return is the discount rate in the present value formula, but the rate which makes net present value 0. The sum of present values of all revenues minus the sum of present values of all the expenses is 0. The project will neither make money nor lose money if the discount rate is the internal rate of return. Another way to describe is that the internal rate of return shows how quickly the project cash flow goes into positive from negative. The quicker cash flow becomes positive, the higher the internal rate of return. For example, two projects A and B have an internal rate of return of 20% and 12% respectively. Project A with 20% IRR is a better choice. IRR is probably the most important financial factor used by organizations when deciding to approve a business case or not. Some organizations have set a minimum IRR threshold. If the expected IRR is below that, the business case will not be approved. One multinational firm had its IRR threshold set at 20%. The direction was that if the estimated IRR is below 20%, do not bother submitting the business case for approval. It will not be even considered.